week in a crypto world. Seriously, it was like a tale of two completely different markets. On one hand, you had absolute panic, a massive sell-off. But behind the curtain, some of the biggest names in tech and finance were quietly making these enormous billion-dollar bets on the future. So let's dive in and try to make sense of what was really going on.
To really get a feel for the fear in the market, you only need to see this one number. In just a single 24-hour window, more than $1 billion in leveraged positions were just gone, wiped out. Now that's the kind of thing that sends real shockwaves through a market, and it absolutely set the tone for the first part of our story this week.
All right, so what exactly triggered this wave of selling? Well, it wasn't just one single thing. It was more like a perfect storm, where a few different factors all came together at once and really put the pressure on traders.
It really kicked off when Bitcoin fell below a major psychological price level. That, plus all the ongoing chatter about interest rates, was enough to send the Fear and Greed Index, which is basically a sentiment meter for the market, plummeting to its lowest point in months. You know, in simple terms, the market got very, very scared, and it happened fast.
And listen, this wasn't just retail investors getting spooked. Not at all. As you can see right here, the big institutional money was also heading for the exits. On just one day, September 25th, the U.S. spot Bitcoin ETFs saw a net outflow of around $258 million. I mean, look at the chart. Only one fund, iShares, actually saw money come in. Pretty much everyone else was selling.
Now, all of this selling pressure got supercharged by something called forced liquidations. For anyone who's not familiar, it's basically when traders borrow money to make bigger bets. If the market moves against them, the exchange just automatically closes their position to pay back the loan. It creates this domino effect, pushing prices down even more, which triggers more liquidations. It's a really brutal cycle.
But, and this is a huge but, while all of that chaos was unfolding out in the open, a completely different story was being written behind the scenes, a story of incredible confidence and huge long-term belief.
So let's completely switch gears and look at the other side of the coin this week. Because while a lot of people were panicking, the heavy hitters were making these massive long-term moves, totally ignoring all the short-term noise.
First up, we've got a gigantic infrastructure deal. We're talking about Google backing a 10-year deal with Bitcoin miner Cipher Mining worth roughly $3 billion. Now stop and think about that for a second. When a company like Google commits to a 10-year, multi-billion-dollar plan, they aren't just dipping their toes in the water. They are making a serious, long-term bet on the very foundation of this entire industry.
Then, you look over at the venture capital world. The crypto exchange Kraken reportedly just locked in a $500 million funding round, and they're already talking about another one that could push their valuation to a staggering $20 billion. That is a massive, massive vote of confidence from investors in a core piece of the crypto ecosystem.
And then there's this number, which is honestly almost hard to wrap your head around. Tether, the company behind the world's biggest stablecoin, is apparently looking at a new funding round that could value it at up to $500 billion. That's trillion with a T. It just goes to show you the mind-boggling amount of capital that's still eyeing this space.
So when you put these deals side by side, you've got infrastructure, exchanges, stablecoins. You're seeing hundreds of billions of dollars in long-term capital being put to work. This isn't about what the price is going to be next week. This is the so-called smart money placing huge bets on where this industry will be a decade from now.
And you know, this long-term confidence isn't just showing up in private deals. We're also seeing this quiet but steady march of progress on the regulatory and institutional side of things, which, you could argue, is even more important for the industry's future.
Take this for example. The UAE officially adopted a global framework for reporting crypto assets. Now, what this means is that by 2028, they'll be automatically sharing crypto tax info with other countries. This stuff might not make flashy headlines, but it is a massive step in weaving crypto into the very fabric of the global financial system. It's about maturation.
And the technology itself just keeps getting more and more validation from serious places. A brand new paper from the United Nations looked at a blockchain project for digital IDs, and they concluded that the tech is, and I'm quoting here, the best for digital verification. I mean, getting that kind of stamp of approval from a body like the UN, that's a powerful signal about the tech's real-world usefulness.
So all of this brings us to the big question.
right? On one side, you have short-term fear, you have liquidations, you have money flowing out of ETFs, and on the other side, you have these multi-billion-dollar deals, regulatory progress, and institutional validation. So how in the world do you square that circle?
So what's the real story? Is it the short-term panic that you see reflected in the price charts? Or is it the long-term quiet confidence shown by these billion-dollar bets from some of the biggest players on the planet? The truth is probably somewhere in the middle, but it really makes you think, which signal do you follow? The short-term noise or the long-term vision? We'll see you next week.